Welcome to Stuck, Time to Improv. I'm Mary Scott with Business Riff. I want startups to be wildly successful. One of the things that startups need to have as a skill is negotiating. And we're going to be talking today with Terry Anderton from Loved about some of the mistakes startups make when they're negotiating. Thanks so much for coming, Terry.
Well, thank you for having me. I'm excited for the conversation.
Yeah. So negotiating has to do with whether or not you get money, whether or not somebody buys so many things, and what kind of mistakes do people make?
Well, in the very beginning, a lot of times people make mistakes with the type of investors that they're targeting and the check size. It's really easy when you're a startup to end up with 100 people on your cap table, which is makes it very difficult down the road if you're raising money in small amounts. And that's always the challenge is, trying to get the biggest check size, the fewest number of investors. And so that's mistake number one is just the check size.
Okay. So if people are thinking about a GoFundMe page, they need to really consider whether this product or service is something that works well under those circumstances, or if they might think of a different way of raising funds, right?
Yeah, I mean that's another strategy, right? Is the crowdsource funding, and those are usually done under certain regulatory constraints. And a lot of times, if you work with a somebody like Start Engine or some of the other crowdfunding platforms, they'll actually set up a separate entity so that all those people that are contributing small amounts of money end up as only being one listing on your cap table. If you could just think about the management nightmare, the governance nightmare of having 1,000 small investors on your cap table would just be overwhelming. So it's best to contain them into a separate entity,
Okay.
special purpose vehicle, or something along those lines.
So, what other kinds of things do startups get themselves into trouble with? Or they start negotiating and people just walk away?
Everybody's they've got a great idea. They want it, their primary goal would be to build their business, stay focused on that. But capital raising can consume so much of your time. In the beginning, it might be 50% of your time just dedicated to capital raising. So being really good at that and understanding how to make those efficient conversations, rule people out, rule people in very quickly, is a good skill to have.
Okay, what kind of criteria should startups use for those sorts of things?
Well, it depends on what type of business they're in. Software startup with a specific kind of targeted tool set. The first layer is this a retail oriented direct to consumer play, or is this a business to business play? And then if it's a business to business play, I think the best way to get started is to find a strategic investor, somebody that actually is in that business that can do more than just provide capital. They can actually give you a pilot or help you in some way with the industry that you're in. So that would be my first advice is just try to go for smart money, not dumb money.
Okay, so I've seen a lot of startups that go straight for investors and they haven't actually validated their idea yet or gotten some friends and family money. So I would think that's another mistake is going for the big money too soon.
Absolutely. There's a lot of people with great ideas and they look good on a PowerPoint presentation. But in this day and age, people want proof points. And so really trying to, you know, reduce the investment risk for the investor by showing you've got a working prototype that it does the function of what you say it can do with some initial customer traction is always the best way to go. The other mistake that a lot of entrepreneurs make is thinking their company is worth more than it is. Um, that's a huge one that will prevent them from being successful.
Is there some place you can kind of vet your company with a third party to figure out how much it's actually worth?
The best way is to do competitive market analysis and try to read, like I use Crunchbase and tools like that. So you can go in and put in a company name and see what their funding rounds look like. Typically, it's not going to tell you what the valuation was, but it will tell you the amount of money raised. And in general, each round is 20 to 30% dilution. So you can kind of infer what the valuation is by the amount of money they raised.
And I'm also thinking that when you're pitching, I've seen startups do a whole deck and not once mention what's in it for the investor.
Yeah, mission critical. Most investors, their thesis is, 5 year rough time horizon, 5 year and out. And so they want to know that once they give you their money, that they can get it back at some point with a significant gain. And so you've got to address that head on in your investment pitch.
Yeah, particularly more specifically how you're going to get it back to them. And that has
Absolutely.
to be a believable, it's got to be a believable plan, right?
I think your exit is almost like your North Star, because
Mhm.
if you don't know what that is, then how do you manage your business from point A to
Sure.
point Z?
Or even going for investors when in fact you're one of the 80% of startups who don't actually need investors, you just need customers. And when you get an investor, they own pieces of your company, so it's not all yours anymore. And that can be a real issue with some startups.
If entrepreneurs are in the enviable position of not needing to raise outside capital, that's great. I still would make an argument that in order to get to the big payouts, a venture capital firm or a strategic investor can add value beyond the money that will help you scale the business and also get credibility. So those, you have to weigh that. Even if you don't need money, I've seen plenty of companies raise it anyway just to get that network.
Right, to get that network, to get those mentors. That's what accelerators are really good for. And you get money when you get accepted into an accelerator, but you get all the mentoring, the program, and the collaboration with the other folks in your cohort, right? So, and
I
then,
agree. I mean, I've seen a lot of there's a lot of really good accelerators. I don't want to criticize them, but as an entrepreneur, you really have to study the terms, because in my experience, accelerators have really onerous terms that are highly dilutive, and on the surface they don't look too bad, but when you realize if they have a warrant attached to them that has a 3 year time span, 3 years down the road you could be in a totally different place, and you're obligated to give them a piece of your company if they exercise their warrant at a very low valuation, and that actually can be an impediment to future investors coming in. So you really have to study those terms well.
do some research on who you're pitching to before you even go there, right?
Exactly.
Well, this has been really interesting. Thank you so much, Terry Anderton from Loved. We'll put your contact information in the comments so people can find you later if they want to know more about negotiating. And I'm Mary Scott with Business Riff. I want startups to be wildly successful, and one of the best things you can do to accomplish that is book a call with me at businessriff.com. And join us again next time for Stop, Time to Improv.